Every single one of these is a real payout from real prop firm accounts, automated, systematic, using zero guesswork. And I'm going to tell you something nobody in this space wants to say out loud. Most people trying to do this are not trading, they are gambling, and they have no idea. Today I'm going to show you exactly why, with real data, real statistics, and the actual mathematical framework that changes everything. Now, you probably have no edge. Let's start with the data because this is not an opinion. Look at this chart. These are verified loss rates from regulators and academic studies across every major instrument. 74 to 89% of retail CFD accounts lose money. That's not from a trading guru, that's directly from ESMA, the European financial regulator, who forced brokers to disclose this publicly. The CFTC in the US says 75 to 80% of retail forex traders are unprofitable. SEBI in India audited 10 million traders and found 93% lost money over 3 years. A peer-reviewed academic study tracked futures day traders for 300 days. 97% lost money. And then look at the last two bars. Only 7% of everyone who ever buys a prop firm challenge receives a single payout. 93 out of 100 people who start this journey never withdraw a dollar. This is not bad luck, this is not the market being unfair, this is the mathematical reality of what happens when people with no systematic edge throw money at highly efficient markets. The instruments you're trading, gold, indices, forex, these are the most liquid, most watched, most competitive assets in the world. Hedge funds, HFT firms, quant funds, with hundreds of researchers, all competing for the same edge you think you found watching YouTube. Now, the probability that you have a genuine alpha on these assets is close to zero, and the data proves it. Now, let's talk about the prop firm trap. Look at this funnel. This is based on FPFX text dataset of over 300k prop firm accounts across 10 firms. 100 traders buy a challenge, 14 pass the evaluation, 11 reach a funded account, and only 7 out of 100 ever receive an actual payout. Most people look at this funnel and think the problem is the strategy. So they buy another course, watch more videos, try a different setup, but that is completely the wrong conclusion. Because here is what most people never think about. When you blow a prop firm account, you didn't lose $100,000. You lose the challenge fee, right? Which is either $200, either $500. That is your maximum possible loss. It is capped. It cannot go higher. But when you pass and get funded and request a payout, that money is real. It hits your bank account. Now let's talk about something that's called a convex payoff structure. Look at this diagram. Your loss side is completely flat, capped at the challenge fee. Regardless of how badly the trading goes, your win side grows linearly. The better the trading, the more real cash you withdraw. The average payout for traders who do succeed is over $8,000. The average challenge fee is under $300. That's a potential 26x return on your maximum possible loss. This is exactly how a call option works. You pay a small premium. If it goes wrong, you lose only the premium. If it goes right, you participate fully in the upside. Now, this changes everything because it means you do not need a strategy that makes money in a real account to make money on prop firms. You need to understand this structure and position yourself correctly inside it. Now, here is where most people get it completely wrong, even the ones who understand the convex payoff. Look at the simulation. Both of these strategies have identical expected value per trade, same drift, same mathematical edge, which in this case is essentially zero, just like most retail strategies. The red paths are a high variance strategy, big swings up, big swings down. The green paths are a low variance strategy, smaller, more consistent moves. Same edge, completely different pass rates, 23% versus 61%. Why? Because a prop firm challenge is not just a trading problem, it is a barrier problem. You have a hard floor below you, the maximum drawdown limit, you have a ceiling above you, the profit target, and your job is to hit the ceiling before you hit the floor. In a barrier problem, variance is your enemy, not your expected value, not your win rate, but variance. If your equity curve is jumping around wildly, big wins, big losses, you are doing a random walk inside a corridor with electric fences on both sides. Sooner or later, you hit the bottom fence, and when you do, game is over. But if your equity curve moves steadily upward with small, consistent steps, you almost never get close to the floor, and eventually you reach the target. The strategy that passes prop firm challenges is not the most profitable strategy. It is the most consistent strategy. Low volatility equity curve, steady positive drift, staying as far away from the drawdown limit as possible for as long as possible. Most retail traders are doing the exact opposite, maximizing variance in the hope of a big win, not understanding that in the specific environment, variance is the thing that kills you. Now, let's talk about why one system is never enough. This is a part nobody talks about. Even if you solve the risk geometry problem, even if you find a consistent low volatility strategy, you still have a problem. Look at these individual system lines. Each one is a real system type. Gold, Nasdaq, UJ, each one has a positive expected value. Each one is a decent system on its own. But each one also has a natural losing streaks, drawdown periods, flat stretches, and in a profit account with a hard drawdown limit, one bad streak from a single system is enough to end the account before your edge has time to play out. Now, look at the green line. That is all 5 systems running at the same time on the same account. The individual systems are volatile, but they are uncorrelated. When one is in drawdown, another is winning. When one is flat, another is running. Combined, the equity curve becomes dramatically smoother. The portfolio drawdown drops from 18% on a single system to around 6% on the portfolio. That is a 3 times reduction in drawdown just from diversification. And in a profit barrier problem, that smooth and green line stays far away from the floor the entire time. It barely gets close to the drawdown limit, while every individual system will have blown the account at some point. This is not complicated mathematics, it is just the basic reality of portfolio construction applied to profit accounts. You are not just a trader, you are running a systematic fund on someone else's capital, and that requires a portfolio, not a single system. Now the framework. Here is the actual framework, the one that makes mathematical sense. 1. Accept that you probably have no edge on individual trades. That is fine, you do not need it. You need to understand the structure you are operating in. 2. Choose strategies with consistent low volatility equity curves. Not because they make the most money, but because they are built for the barrier problem you are actually solving. 3. Never run a single system. Build a portfolio of uncorrelated systems across different instruments and different logic. The smoothing effect is your real edge. And 4. Treat every profit account like a structured product. Know your probability of passing before you spend $1 on challenge fees. If you cannot model it, you are gambling. 5. Automate everything. The moment you introduce discretion, you introduce emotion. Emotion destroys consistency. Consistency is the only thing that matters here. This is not complicated, but it requires you to think like a systems builder, not like a day trader. Now, the people making consistent money on prop firms are not the ones with the best entries. They are not the ones who found the secret pattern or the magic indicator. They are the ones who understood the mathematics of the structure they are operating in and built everything around that. If this is how you want to approach trading, systematically, with no guesswork, no emotions, make sure to subscribe, follow me on Twitter, and visit thesystemtheory.com. Everything I trade, everything I build, everything I test, I document it publicly. See you in the next one.